Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. I just wanted to announce that Robert out of Australia is the winner of this week's American Eagle Silver Round. We're giving away one free ounce per week for the remainder of the year. Just go to palisaderadio.com and sign up for the silver giveaway. Now, I'm delighted to have famed author and economist Mr. Jim Rickards back on the show today. Jim, welcome back.
Thank you, Colin. Great to be with you.
Today we're going to discuss your new book, which is called The Road to Ruin, The Global Elite Secret Plan for the Next Financial Crisis. Your new book is slated for release on November 15th, and I was fortunate enough to have an early read. Excellent work, as always, Jim. I've read Currency Wars, The Death of Money, and The New Case for Gold. Your books work quite well as standalone pieces, but I really enjoy them going in succession. And the story begins with an unheard of economist, an Austrian Swiss banker named Felix Summery, who lived from 1881 to 1956. Summery developed a concept called Bayesian statistics, which allows for a predictive model based on one data point inputting future data as they emerge. And I'm going to turn this over to you to really explain, but basically Bayes' theorem allows an analyst to reach a conclusion ahead of the crowd. And this leads into a concept called complex systems, which you focus a lot of the book on. Why are complex systems so important, Jim?
Well, that's about 4 questions, Colin. I love the way you condensed all that. So let's unpack it a little bit and address all of them, because those are great questions. First of all, Felix Summery, I describe him in my book as perhaps the greatest economist of the 20th century, but I had not even heard of Felix Summery until about a year and a half ago, and 2 good friends of mine, Ronnie Staffelli and Mark Valek in Vienna, were very familiar with his work. Summery was born in the late 19th century, lived through pretty much the first half of the 20th century, died in 1959, went to the University of Vienna, was right in the thick of the creation, early days of Austrian economics, classmates with Joseph Schumpeter, a PhD student of Karl Menger. I mean, his as I say, his credentials are first rate, and also Egon von Bailout, another very famous, Eugen von Bailout, another very famous Austrian economist. So that's his origin. But he wrote a book, a memoir called The Raven of Zurich, and Ronnie recommended it to me. And I located a copy. It's been out of print for over 30 years. You can only buy it in kind of a secondary market. You can find it on Amazon, but anyone who's interested, I'll just warn the listeners in advance. The copies at the low end are $700-800 a copy, and some of them are even more. So it's a real collector's item, but I was able to get my hands on a copy in English, read it, and was just blown away by the quality of the analysis and the economic history and the economics embedded in it, and decided to make Summery sort of a centerpiece or thread in my book, The Road to Ruin. Now, you mentioned his connection to Bayesian statistics. Just to put a little more clarity around that, Bayes' theorem, which is the applied mathematical formula that's at the heart of Bayesian statistics, is actually over 200 years old. This goes back also to the 18th century, a minister named Thomas Bayes, and then it was updated in the early 19th century by Simon Laplace, a French mathematician. And I use Bayes' theorem a lot, and I talk about it a lot in the book. Summery himself, I don't think he would necessarily have been familiar with Bayes' theorem and did not use it explicitly. The point I make is that he was using it intuitively. When you look at his success in preserving client wealth and protecting his investors and advising governments and understanding economic developments, he was clearly using Bayes at an intuitive level, even if he wasn't, crunching the numbers and doing the math. And Felix Summery's nickname, if you will, what his friends sometimes called him and what his memoir is called, was The Raven of Zurich. Zurich because he lived there most of the second half of his life, but the raven because in Greek mythology and even in Old Testament literature and some modern literature, the raven is always a symbol of prophecy. So it's really calling him the Raven of Zurich was a tribute to his ability to foresee events unfolding, including, in his case, in advance, World War I, the hyperinflation that followed, the deflation that followed that, the Great Depression, World War II, and the rise of the international monetary system under Bretton Woods. He foresaw every one of those things and was able to be nimble with his clients' wealth and preserve money. But the question is, how did he foresee it? And a lot of people think, well, you have a crystal ball or you're looking over the horizon or you see the future. That's not quite it. And that's not what Bayes' theorem teaches. What you would say is that the future is not really the future. The future is here today, embedded in the present. You just have to know where to look. You have to dig down to find the data, and then you have to have the right models and understand the dynamic processes. And if you can get the data and understand the process, you can know what's going to happen next. Not because you have a crystal ball, but because you're just extrapolating in the right way from an existing process. So a very simple example of that, Colin, imagine a row of dominoes lined up, a long row, and I tip over the first domino, and it hits the second one, hits the third one. They all start falling down. And you say, you know what? I have a prediction. I predict the last domino is going to fall. And we wait a few seconds, and boom, the last domino falls. So your prediction had 100% accuracy. But was it because you saw the future, or was it because you observed the present and saw a dynamic process underway, understood the process, and were able to correctly say what was going to happen next based on what was already happening? That's what Bayes' theorem allows you to do. That's what Summery does intuitively. That's what I talk about in The Road to Ruin. So when I talk about a financial crisis worse than the last one that could happen, I use 2018 as an illustration, but I'm not saying it's absolutely going to happen, January 1st, 2018. I think 2018 is a reasonable estimate, but I make the point that it could be tomorrow. Because the forces are already in place. They're already in place. So when I talk about this crisis, I make the point that conditions today, processes today, and the instability of the system are going to cause this financial crisis to happen. And you can see it today. You don't have to wait until it actually happens. So I use Bayes' theorem. Summery used it, I would say, intuitively, even if he didn't write down the equations, and it is an extremely useful tool. You also mentioned complexity theory, which I also use. Complexity theory is a little different than Bayes. Bayes is a formula, a theorem that you use when you don't have a lot of information. If you had just millions and millions of bits of information or data points, and the kind of thing that high-frequency traders use, so-called frequentist statisticians use, and you had long time series, and you could run regressions and correlations and come up with a covariance matrix and use all of that to guess what's going to happen next based on an assumption that the future will resemble the past. A lot of problems in that assumption, by the way, but that's what a so-called frequentist statistician do. That's what most of Wall Street does. That's what central bankers do. But with Bayes' theorem, you take a very different approach. You say, I don't have a lot of information. I don't have a lot of time series. When we used this at CIA to do counterterrorism work after 9/11, we only had one data point, which was 9/11. We didn't have 1,000, mass casualty attacks in the United States. There had only been one. It was 9/11. So that was a pretty small information set, but it was our job to predict the next one. How do you do that when you don't have a lot of data? And the answer is you use Bayes' theorem. Complexity theory, on the other hand, is an understanding of the dynamic processes. I said use Bayes to figure out what's going on, but then use complexity theory to see the dynamics and the underlying dynamics and what's going to happen next. And there, again, I think Summery was a good exemplar of that, but complexity theory was only discovered really in 1960. Now, complex dynamics have been around since the Big Bang. Complex dynamics have been around for 13 billion years. You can look at them when you look up at the night sky and see a star. That's a complex system. But the formal science, turning it into a tool that you can use and write equations and program and actually get good results, that's fairly recent. That really dates to 1960, but that's another powerful tool we use. So so I admire Summery for his open-mindedness, his willingness to think outside the consensus. I think he was an intuitive Bayesian, even if he wouldn't have used the word, and he had a good grasp of complexity theory, even if he preceded that science by 50 years.
Jim, you point out in The Road to Ruin that most academic economists are not scientists, but rather dogmatists clinging to old versions of science, and this would not be an issue except for the very real issue that these academics are now in control of the central banks and finance ministries of the world, and if their worldview is wrong, we have a very, very big problem. Indeed, you say their worldview is wrong. And this leads me into your prediction of a financial crisis. I'm going to quote from your book. You say, the stage is set. A global financial crisis worse than any before is imminent for reasons explained in this book. A liquidity injection of the kind seen in 1998 and 2008 will not suffice because central bank balance sheets are stretched. There will be little time to respond. ICE 9 account freezes will be used to buy time while global elites convene. And I'm going to stop there and let you lead in here. This is very interesting to me, and most people think that we're going to have a repeat of 2008. You say, no, we're not. This is going to be totally different.
Correct. We are going to have a repeat in the sense that we're going to have another global financial crisis, global liquidity crisis, but the response function will be entirely different, and I'm very happy to explain why. On your first point, Colin, about economics and science and are economists scientists, the reason I make that point is a lot of people say, well, economics is not science. Because they'll look at forecasting and say, it's really a mess. The Federal Reserve has been wrong by orders of magnitude 8 years in a row in their growth and inflation forecasts. The IMF likewise wrong 8 years in a row. They're continually lowering their forecasts. And when you get really bad results like that, and then you don't have any predictive analytics, you cannot see crises coming. Ben Bernanke famously in 2007, I think March 2007, when the mortgage crisis first started to emerge, said, "Oh, this will blow over." Later, he said, "It's never been the case that all the home values in the entire United States could decline at once. It's always regional or local." He was wrong about every one of those things, and so was the Fed, and so were the other central banks. And so when you have that kind of track record, people throw up their hands and say, "Well, how could this be science? This is not science. This is, at best, some kind of guesswork." And I make the point that economics actually is science. The problem is the economists are not scientists. They are dogmatists. They are ideologues. They are letting their preconceived notions and their political preferences get in the way of good objective analysis, keeping an open mind, using scientific method. And I describe in the book how the scientific methods that actually could work and ways forward with very specific examples and some equations, not a lot. The book's not full of math, but there's enough math in there. Not that difficult to follow, by the way, to help readers see what I'm talking about. But it's not just math. There are plenty of stories, plenty of just plain English analysis. I try to avoid jargon, hopefully completely, not use any jargon at all, and just kind of talk in plain English. So that's I am sort of saying the economics can be a science, is a science, but you need scientific method to go with that. Most economists don't live up to that standard. As far as the reaction function in the next crisis is concerned, I use 3 crises to illustrate my point. I pick 1998, 2008, and then 2018, a future crisis, and really just to maintain that 10-year tempo. So it was almost exactly 10 years between the panic of 1998 and the panic of 2008. So just tack on another 10 years. Imagine you're in the summer of 2018 and we're having the third financial crisis. Although I do make the point that 2018 is, it's an estimate. It could very well happen then, but it could happen sooner. It could happen tomorrow. Investors should not wait until 2018 as if somehow that's exactly when it's going to happen. It could happen tomorrow. You should be prepared tomorrow. But anyway, that's a sort of a device to create this 10-year tempo. Now, in 1998, what happened? That was the Russia long-term capital management crisis. I was the lawyer for long-term capital management. I negotiated that bailout. I was in the room with the Treasury and the Fed and the heads of the banks. I know exactly what happened and what was going to happen next if we didn't get that bailout done. We came hours away, just hours away from closing every stock exchange and bond market in the world. And basically Wall Street got together and bailed out a hedge fund with a lot of assistance from the Federal Reserve, both in terms of convening the first meeting to get the bailout talks going and then cutting interest rates the day after the bailout and then cutting them again at an emergency meeting, not at a scheduled FOMC meeting, but at in effect, an executive session in mid-October 1998. 2008, again, I think listeners know the story, the mortgage meltdown, the financial panic, et cetera. But again, in September, we were just days away from the sequential collapse of every bank in the world. We had, Bear Stearns failed in March 08, Fannie Mae and Freddie Mac failed in June and July 08. Lehman Brothers failed in September 08. Without intervention, Morgan Stanley would have been next, probably within days. Then Goldman Sachs, then Citibank, then Bank of America, then JP Morgan. These banks would have fallen exactly like the dominoes we talked about a few minutes ago. Now, that didn't happen, again, because the Federal Reserve truncated the process. The Federal Reserve intervened and intervened massively. And it wasn't just the $4 trillion of money that they printed on their balance sheet over the next 8 years, but right then and there, they did $10 trillion of hidden swaps with the European Central Bank. The story there is that the European banks had dollar assets. They needed to fund them with dollar liabilities. A lot of those liabilities were commercial paper and bank CDs that were taken up by U.S. money market funds. So U.S. investors were in a panic. They were taking their money out of the money market funds. The money market funds could not roll over the paper of the European banks. The European bank dollar liquidity was drying up. They turned to their lender of last resort, the European Central Bank, but there was one problem. The European Central Bank can't print dollars. It can only print euros. So what happened was the European Central Bank printed tens of trillions of euros. The Federal Reserve printed tens of trillions of dollars, and then they swapped. The Federal Reserve got the euros, and the European Central Bank got the dollars from the Fed, and then used that to bail out their part of the banking system. And then the Fed and the FDIC together guaranteed every bank deposit in America, regardless of size, just blew past the insurance limit of $250,000 per account and guaranteed unlimited amounts, and guaranteed every money market fund in America, which they had no legal obligation to do whatsoever. So that was massive money printing, money swaps, guarantees, et cetera, to prop up the system. So both times, in 1998, everybody wanted their money back. The Fed gave them their money back. In 2008, everybody wanted their money back. The Fed gave them their money back. In 2018, or perhaps sooner, everybody's going to want their money back again because that's what a financial panic is, but they're not going to get their money back. And the reason is the Fed is tapped out. They took their balance sheet to $4 trillion, as I described. If somehow over the last 4 or 5 years they had normalized their balance sheet, taken it back down to say I'm sorry if I said 4 trillion, I meant to say 4 billion, I meant to say 4 trillion. If I misspoke, $4 trillion. If somehow they had normalized and got the balance sheet back to $1 trillion or less and had got interest rates up to 2 or 3%, which would be a normal level for the stage of an expansion, I'd be the first one to congratulate them. Say, hey, nice job, guys. You did it. You saved the world. You got your balance sheet down. You got interest rates up, and you're ready to fight the next crisis. But that is not what happened. The balance sheet is still at $4 trillion. Interest rates are still close to zero. The Fed has no added capacity, no headroom or space to deal with the next crisis. So the only clean balance sheet in the world is the IMF. That's the only source of liquidity in the world. By the way, the other central banks are worse than the Fed. ECB, Bank of England, Bank of Japan, People's Bank of China. You look around, they've all done the same thing. People's Bank of China actually printed more money than the Fed, if you can believe that. So they're all tapped out. They're all at the outer limit of what they can do to respond to a crisis. They're not going to be a source of liquidity in the next crisis. They won't be able to. But the elites have a plan, and that's the secret plan that I talk about in the subtitle of my book. The plan is, instead of giving people their money back, they're going to lock down the system. They're not going to let you get your money back. They're going to freeze bank accounts, close banks if necessary. Money market funds will suspend redemptions. Stock exchanges will be closed. ATMs will be reprogrammed so that they'll give you perhaps $300 a day in gas and groceries, or perhaps nothing at all. They'll be closed at all. It'll be exactly like Cyprus and Greece, except on a global scale. To buy time, they'll say this is temporary. They'll be buying time until the IMF, the International Monetary Fund, can print up and distribute the trillions of SDRs. Notice I didn't say trillions of dollars. Trillions of SDRs worth even more if you translate them to dollars. So maybe $7 or $8 trillion equivalent of SDRs to reliquify the world. But the IMF is not that nimble. I mean, they can move quickly, but not that quickly. It'll take them 3 to 6 months, maybe longer. Last time they did this, it took 11 months to get the SDRs issued. But in that 3 to 6 month stage of acute panic, they're not going to give you your money back. They're going to lock down the system. I call this ICE 9 as a tribute to Kurt Vonnegut, a very famous author who wrote a book in the early 60s called Cat's Cradle. It's a darkly comedic novel, which I highly recommend. It's hilarious, short, easy to read, but Vonnegut hypothesized a doomsday machine he called ICE 9. And ICE 9 is a molecule similar to water, very close to H2O, a polymorph of H2O, with two distinct characteristics. Number one, it has a melting temperature of 114 degrees Fahrenheit, which means it's frozen at room temperature. And number two, when a molecule of regular H2O comes in contact with a molecule of ICE 9, the H2O turns to ICE 9. The ICE 9 was kept in vials, and the notion was if you opened the vial and poured ICE 9 into a normal standing body of water, then all the streams, lakes, rivers, oceans of the world would turn to ice, and the planet would freeze, and life on Earth would die. So that was the doomsday scenario. I use that metaphor to describe what will happen to the financial system, because you can't lock down part. If you lock down, let's say you suspend redemptions in money market funds because there's a run on money market funds, well, then everyone will just go to the bank and take the money out of the banks. And so you close the banks, everyone will just sell stocks and try to get the money that way. So you have to close the stock exchange, and on and on and on. In other words, this financial lockdown will spread the same way ICE 9 molecules spread until the whole planet is frozen, until the whole financial system is frozen and locked down. So the panic will start the same way, but it'll be bigger. The central banks won't be able to stop it, and they'll have to turn to an ICE 9 solution, lock down the system until they can print up the SDRs, and that's what's going to be different.
I know we're on a very tight clock here. I just have two more brief questions to gauge your timing on the answers. In the early part of the book, Jim, you tell a story of sitting with the head of BlackRock, or a head of BlackRock, and BlackRock is by far the largest asset manager in the world with over $5 trillion under management. What your story underlines is that the elite are already preparing for this ICE 9 setup. Can you just briefly tell our listeners what transpired on that in that meeting?
Sure. It was a dinner actually with one of the top officials at BlackRock who had she was on point in terms of negotiating with the U.S. government. This was at a time when the U.S. government was coming up with this so-called SIFI, which stands for Systemically Important Financial Institution, and there's a global version of that, and there are variations of that. They're not all banks, but basically the government was trying to designate or tag certain mega institutions with this status so that they could order them to do certain things in the next panic. And BlackRock was pushing back, saying, well, wait a second, we're not a bank. We're not even leveraged. We're a wealth manager. We don't have liabilities. You know, a bank has assets, and they fund it with liabilities such as deposits. And it's when all the depositors want their money back, there's a run on the bank that causes problems. But BlackRock was saying, well, no, we manage assets, but they're not our assets, they're the client's assets. And by the way, we don't have any offsetting liabilities. We didn't borrow the money, the clients gave it to us. So you ought to leave us out of this. But the government was insisting anyway. And the reason was that in the next panic, they want to be able to order BlackRock not to sell. There won't be a run on BlackRock because BlackRock doesn't have those kind of liabilities, but their clients will be calling them up saying either give me my money back or sell everything. And BlackRock is obliged as a fiduciary, as a wealth manager, to go ahead and do that. And the government wants to say, no, you can't. And whether your clients are China or CalPERS, the California Public Employee Retirement System, et cetera, that we're going to freeze that. So that's part of the ICE 9 solution. It's not just closing banks, although that's part also. It's telling asset managers that they cannot sell. But it's a I hope a powerful and interesting anecdote. But to me, it's just part of a much larger puzzle. And the point you made, Colin, is that this is already in place. They're not going to have to run to Congress the way they did with TARP and get a vote and get some money approved or authorized. All the provisions that the government needs are already in place. They've either been around for a long time, and people maybe didn't know how to use them in 2008, but they figured it out since then, or they're newly enacted, whether it's the Patriot Act or Dodd-Frank or the SEC rules on money market funds, suspended redemptions, et cetera. They've been put in place in the meantime. This all comes under the heading of macroprudential regulation, which is the IMF's favorite hobby horse for what I call ICE 9. But it's all in place. It's been rehearsed. It's been discussed. It's been studied and agreed, and they will lock down the system.
All right, my final question has to do with SDRs and gold. A quote from the book, you say, "The end result is ICE 9 for gold. Gold exchanges will halt trading, contracts will be terminated and settled in dollars at the last closing price. Counterparties will lose out on future price appreciation and access to physical gold." That part is pretty self-explanatory, but the implications are crucial, of course. And on the point of SDRs, Jim, I've noticed in earlier books you were indicating SDRs as a potential replacement of the current monetary system. In this book, you really hit home that you think this is a near certainty. Why the change there?
Because it's already happening. You're right. In both currency wars, but to a greater extent in the death of money, I talked about the future of SDRs, but today it's no longer the future. It's here. As recently as October 1st, 2016, the IMF included the Chinese yuan in the SDR reference a group of currencies. There were only four reference currencies, euros, dollars, sterling, and Japanese yen. Now that's been expanded to include the Chinese yuan. The reason they did that, the Chinese yuan did not qualify for that status under the IMF's own criteria, but the reason they did that is they're getting ready to issue SDRs in the next panic, and they're going to need China's vote to do that. China is about 15% of global GDP. It's 10% of the voting power at the IMF. It's the second largest economy in the world. There's no way the IMF is going to be able to do something that's significant without getting China's acquiescence. And China was saying, well, why should we agree to that if we're not in the SDR? Why should we agree to let you issue SDRs if we're not part of it? And the IMF agreed with that and said, okay, now you're in the club. So that's one example. On July 15, 2016, the IMF issued a working paper that called for the creation of what are called MSDRs as opposed to OSDRs. What are those? The OSDR is O for official. The official SDR, that's the one the IMF prints and issues to its members. But the MSDR is the market SDR. So here you have the IMF encouraging the creation of a private market of bonds issued by various institutions. And right on cue, no sooner had the IMF released that paper than the World Bank issued a $2 billion SDR bond issue in August. And notice, again, I didn't say $2 billion or 2 billion euros. I said 2 billion SDRs. So they're creating liquidity in SDRs, and they're getting ready to print more, and that's why they included China in the club. So my point is, this is already happening, and it's very far along, and they're ready for the next time, ready for the next crisis. The question is, the IMF is ready, the central banks are ready, but investors are not because no one's explaining it to them. And that's exactly what I do in my book, The Road to Ruin.
Great. Well, Jim, a lot of people might ask you why you would publish 2 books in 1 year, and after reading this one, I'd wish you'd publish 2 books every year. The Road to Ruin, the Global Elite's Secret Plan for the Next Financial Crisis is out on November 15th, and we will be including a link for the pre-order page on Amazon in our newsletter here. Jim, thank you so much for coming back on the program.
Thank you, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?